Part 1. Introduction and why dividend investing matters. Imagine owning a piece of a business that sends you cash every 3 months simply because you own it. No tenants to manage. No inventory to store. No late-night phone calls. Just a steady deposit into your brokerage account as your share of that company's profits. That is the core idea behind dividend investing for beginners, and when understood properly, it becomes one of the most powerful frameworks for building long-term wealth and sustainable passive income in the United States stock market. In this masterclass, we are going to walk step by step through everything you need to understand about dividend investing. Not just what dividends are, but how they work, how to analyze them, how to build a resilient dividend portfolio, how taxes affect your income, how to think during market crashes, and ultimately how to design a long-term strategy that supports financial independence. This is not about hype. It is not about doubling your money overnight. It is not about chasing the highest dividend yield you can find. This is about building ownership in real businesses that generate real profits and sharing in those profits year after year. Let's start with the foundation. When you buy a stock, you are not buying a ticker symbol. You are not buying a line on a screen. You are buying partial ownership in a real company. If you own shares of a large consumer company, you own a small slice of its global operations. If you own shares of a technology firm, you own a slice of its innovation engine. If you own shares of a major healthcare company, you own a slice of its patents, research, and distribution network. Companies exist to generate profit. After they pay their expenses, invest in growth, and manage their operations, they are left with net income. Management then has a decision: reinvest all profits back into the business, use some for acquisitions, reduce debt, buy back shares, or distribute a portion to shareholders as dividends. Dividend investing focuses on companies that consistently choose to share part of their profits with shareholders in the form of cash payments. If you have never thought about the stock market this way, it changes everything. Instead of hoping someone else pays more for your shares in the future, you are focusing on businesses that pay you while you own them. That distinction is critical. In traditional growth-focused stock market investing, the primary goal is capital appreciation. You buy a company at one price, and ideally you sell it later at a higher price. The return is realized when you sell. Until then, gains are mostly on paper. In dividend investing, you still care about growth and price appreciation, but you also receive ongoing income along the way. Even if the stock price moves sideways for a period of time, you may still be collecting dividend payments. This shifts your psychological relationship with the market. You move from being purely price-focused to being income-focused and business-focused. That does not mean dividend investing is automatically superior to growth investing. Many of the most successful companies in history paid little or no dividends in their early growth phases. Reinvesting profits internally can sometimes generate enormous long-term total return. The key is understanding your objectives. Are you trying to build assets that generate steady passive income over decades? Are you looking for a way to supplement retirement income? Are you aiming for financial independence, where your investments cover your living expenses? If so, dividend investing can play a powerful role in that strategy. At its core, dividend investing for beginners is about building a portfolio of cash-flowing assets within the stock market. Think of it as constructing a portfolio of miniature income-producing machines. Each company operates independently, earning revenue from customers around the world. As a shareholder, you receive your share of that success. But here is where many beginners misunderstand the concept. Dividends are not free money. When a company pays a dividend, it is distributing part of its retained earnings. The company's value adjusts accordingly. There is no magic. The value is being transferred from the company to you. What makes dividend investing powerful is not the payment itself, but the combination of consistent distributions, dividend growth over time, and compound interest when those dividends are reinvested. Over years and decades, that process can become extraordinary. Consider a simple scenario. You invest in high-quality blue-chip stocks that yield around 3% annually and grow their dividends at 6 to 8% per year. You reinvest every dividend through a DRIP, which stands for Dividend Reinvestment Plan. Over 20 or 30 years, your income can multiply several times over, not because you traded constantly, but because you allowed compounding to work. That is the quiet engine behind long-term wealth. When most people think about building wealth in the stock market, they focus almost exclusively on price movement. They ask, what stock will double next year? Experienced investors ask a different question. What businesses can I own that will continue generating profits and increasing distributions over decades? That subtle shift is the difference between speculation and strategy. Dividend investing also encourages a longer time horizon. When your goal is rising income, short-term volatility becomes less threatening. If you own a company that has paid and increased dividends for 25 consecutive years, a temporary 15% drop in share price may not disrupt your income stream at all. In fact, it may provide an opportunity to buy more at a higher dividend yield. This mindset is essential. The U.S. stock market has historically rewarded patient investors. Over long periods, broad market returns have averaged roughly 8 to 10% annually, including dividends. A significant portion of that total return has come from reinvested dividends. Many beginners underestimate how much of the stock market's long-term growth comes not just from price appreciation, but from dividends and compound interest. If you ignore dividends entirely, you are ignoring a major driver of wealth accumulation. Now let's clarify what dividend investing is not. It is not a guarantee of steady income. Companies can cut or suspend dividends during economic stress. It is not risk-free. Stock prices fluctuate and businesses can fail. It is not a shortcut to financial independence in a few years without meaningful capital and consistency. Dividend investing is a disciplined process of selecting financially strong companies with sustainable payout ratios, consistent earnings, and a history of responsible capital allocation. It requires patience, it requires analysis, and it requires realistic expectations. One of the most powerful aspects of dividend investing for beginners is that it aligns well with human psychology when done properly. Receiving regular cash payments reinforces the feeling that your investments are working for you. Instead of staring at fluctuating prices, you can track the growth of your dividend income year after year. Imagine reviewing your annual dividend income and seeing it rise from $1,200 to $1,450 to $1,700 to $2,050 over several years. Even if market prices fluctuate, your income stream continues growing. That tangible progress helps many investors stay disciplined during volatility. And discipline is everything in long-term investing. Let's zoom out and connect this to the concept of financial independence. Financial independence occurs when your investment income covers your living expenses. That income can come from multiple sources: rental properties, businesses, pensions, bonds, or dividend stocks. A well-constructed dividend portfolio can become one of those pillars. If your annual expenses are $50,000, and your portfolio generates $50,000 in reliable dividend income, you have reached a form of financial independence. You no longer depend entirely on earned income from employment. But reaching that point requires understanding more than just buy high-yield stocks. It requires understanding dividend yield, payout ratio, dividend growth, risk management, taxes, and portfolio construction. That is exactly what this masterclass will cover. We will start by breaking down how dividends actually work at the corporate level. You will understand how profits flow from customers to companies to shareholders. We will define critical terms like dividend yield and payout ratio so that you can evaluate opportunities intelligently rather than emotionally. Then we will examine the real engine behind wealth creation: dividend reinvestment and compound interest. You will see how modest returns, when reinvested consistently over decades, can outperform more aggressive strategies that lack discipline. From there, we will move into building your first dividend portfolio. You will learn how to diversify across sectors, how to think about blue-chip stocks versus exchange-traded funds, and how to balance income with total return. Later sections will teach you how to analyze dividend stocks properly, how to avoid dividend traps, how to compare dividend growth investing with high-yield strategies, and how taxes in the U.S. affect qualified dividends versus ordinary income. We will also address something every serious investor must confront: risk. Market crashes happen. Recessions happen. Dividends can be cut. You will learn how to evaluate resilience and how to maintain a long-term mindset when volatility strikes. Finally, we will bring everything together into a practical framework for estimating passive income targets and building a strategy aligned with your personal timeline and goals. This is not about predicting the next hot stock. It is about building a system. A system where your money buys ownership in productive assets. A system where those assets generate cash flow. A system where that cash flow is reinvested and compounds. And a system that, over decades, can support real financial independence. If you approach dividend investing with clarity, patience, and discipline, it becomes less about chasing returns and more about constructing a durable financial architecture for your life. In the next part, we will move from philosophy to mechanics. You will learn exactly how dividends are declared, how dividend yield is calculated, what payout ratio tells you about sustainability, and how key dates like the ex-dividend date and record date actually work. Understanding these mechanics transforms dividend investing from a vague concept into a precise tool. Let's build that foundation next. Part 2. How dividends actually work. Now that we have established why dividend investing matters, we need to understand how dividends actually work at the business level and inside your brokerage account. This is where many beginners get confused, and confusion leads to poor decisions. At the highest level, dividends are simply a distribution of corporate profits to shareholders. Let's walk through the process from the ground up. A company generates revenue by selling products or services. From that revenue, it pays operating expenses, salaries, research and development costs, interest on debt, taxes, and everything else required to run the business. What remains after those expenses is net income. That net income belongs to the shareholders. Management is entrusted with deciding how to allocate it. Broadly speaking, there are 4 primary options. The company can reinvest profits back into growth initiatives such as expanding operations, launching new products, or entering new markets. It can reduce debt, strengthening the balance sheet. It can repurchase its own shares through stock buybacks, effectively increasing each remaining shareholder's ownership percentage. Or it can distribute part of those profits directly to shareholders in the form of dividends. When a company chooses to pay a dividend, it typically does so on a quarterly basis in the United States, although some companies pay annually or monthly. Now let's define the most important metrics you will encounter in dividend investing for beginners. Dividend yield, payout ratio, and dividend growth rate. Dividend yield is the annual dividend payment divided by the current stock price. It is expressed as a percentage. If a company pays $4 per year in dividends and its stock trades at $100 per share, the dividend yield is 4%. If the stock price falls to $80 while the dividend remains $4, the dividend yield rises to 5%. If the stock price increases to $125, the yield falls to 3.2%. This is important because dividend yield moves inversely to price. A high dividend yield does not automatically mean the company increased its dividend. Sometimes it simply means the stock price has declined. Beginners often make the mistake of chasing the highest yield available. But a very high dividend yield can signal financial stress, not opportunity. We will discuss dividend traps later in this masterclass, but for now understand that yield must always be evaluated in context. Next we have the payout ratio. The payout ratio measures what percentage of a company's earnings are being paid out as dividends. It is calculated by dividing the annual dividend by earnings per share. If a company earns $5 per share and pays $2 per share in dividends, the payout ratio is 40%. That means 40% of profits are distributed, and 60% are retained for reinvestment or other uses. In general, a lower payout ratio suggests more room for dividend sustainability and growth. A payout ratio above 80 or 90% can be risky, depending on the industry, because the company is distributing nearly all of its earnings. Any decline in profits could force a dividend cut. Some industries, such as utilities or real estate investment trusts, often have structurally higher payout ratios. Context matters. But for most traditional corporations, a moderate payout ratio between 30 and 60% is often considered healthy and sustainable. Then we have dividend growth rate. Dividend growth rate measures how quickly a company increases its dividend payments over time. If a company paid $1 per share 5 years ago and now pays $1.50 per share, it has increased its dividend by 50% over that period. The annual growth rate might be around 8 to 9% per year. Dividend growth is a critical concept because it directly impacts your long-term passive income. A stock yielding 2.5% today but growing its dividend at 10% per year may produce far more income over 20 years than a stock yielding 6% with no growth. Now let's examine the mechanics of dividend payments inside the stock market. There are 4 key dates you must understand: declaration date, ex-dividend date, record date, and payment date. The declaration date is when the company's board of directors announces the dividend. They specify the amount to be paid, the ex-dividend date, the record date, and the payment date. The ex-dividend date is one of the most misunderstood concepts in dividend investing for beginners. This is the cutoff date that determines who receives the upcoming dividend. If you purchase the stock before the ex-dividend date, you are entitled to receive the dividend. If you purchase on or after the ex-dividend date, you will not receive that payment. Why does this matter? Because stock transactions in the United States settle on a standard settlement cycle. The ex-dividend date ensures that the ownership records are properly updated before the record date. The record date is the date on which the company reviews its shareholder list to determine who officially owns the shares and will receive the dividend. Finally, the payment date is when the cash is actually distributed to shareholders' brokerage accounts. Here is a simple example. A company declares a $1 quarterly dividend. The ex-dividend date is April 10th. The record date is April 11th. The payment date is May 1st. If you buy the stock on April 9th, you qualify for the dividend. If you buy it on April 10th or later, you do not receive that dividend. On May 1st, the $1 per share is deposited into your account. Now let's address a common misconception. Some beginners believe they can buy a stock one day before the ex-dividend date, collect the dividend, and then sell immediately afterward for easy profit. In reality, this does not create free money. On the ex-dividend date, the stock price typically adjusts downward by approximately the amount of the dividend. If a stock closes at $100 and pays a $1 dividend, it may open around $99 on the ex-dividend date, all else equal. The value has simply shifted from the company to you in the form of cash. There is no arbitrage opportunity in normal conditions. Another misconception is that dividends are guaranteed. They are not. Dividends are discretionary. Even companies with decades of consistent payments can reduce or eliminate dividends during severe economic stress. During major recessions, some firms reduce payouts to preserve cash. Others maintain or even increase dividends if their business models are resilient. Understanding which companies have stable earnings is essential for protecting your dividend portfolio. It is also important to understand the difference between dividends and total return. Total return includes both price appreciation and dividends received. If a stock increases 6% in price and pays a 3% dividend, your total return is approximately 9%, assuming dividends are not reinvested. If dividends are reinvested, total return compounds even faster. Many long-term studies of the U.S. stock market show that reinvested dividends account for a substantial portion of long-term returns. Ignoring dividends can significantly understate the power of compound interest. Another concept worth clarifying is the difference between individual dividend stocks and dividend-focused exchange-traded funds. When you purchase individual stocks, you directly own shares of specific companies. You are responsible for analyzing each company's earnings, payout ratio, debt levels, and competitive position. When you purchase a dividend-focused ETF, you are buying a basket of dividend-paying companies in a single transaction. These funds may focus on high yield, dividend growth, or companies with long histories of increasing dividends. This can provide instant diversification, which is especially helpful for beginners. But whether you own individual blue-chip stocks or dividend ETFs, the mechanics of how dividends work remain the same. The company earns profits. The board declares a dividend. The ex-dividend date determines eligibility. The payment date delivers cash to your account. Now let's connect this back to your long-term strategy. Understanding dividend yield helps you estimate your income potential. Understanding payout ratio helps you assess sustainability. Understanding dividend growth rate helps you forecast how your passive income may evolve over time. These metrics transform dividend investing from a vague concept into a structured evaluation process. Instead of asking, "Does this stock pay a high dividend?" you begin asking more intelligent questions. Is the company consistently profitable? Is the payout ratio sustainable? Has the company demonstrated long-term dividend growth? Does the business model support earnings stability during economic downturns? This is the mindset shift from speculation to ownership. In the next part, we will explore the real force multiplier in dividend investing: dividend reinvestment and compound interest. You will see how reinvesting even modest dividend payments through a DRIP can dramatically accelerate wealth accumulation over decades. Understanding how dividends work gives you the tools. Understanding compounding gives you the engine. Let's examine that engine next. Part 3. The power of compound interest and reinvestment. Now that you understand how dividends are generated, declared, and paid, we can move into the engine that makes dividend investing so powerful over long periods of time. Compound interest through dividend reinvestment. This is where dividend investing for beginners transforms from a simple income strategy into a long-term wealth-building system. Let's start with a simple question. What happens when you receive a dividend? In a standard brokerage account, the dividend is deposited as cash. You can withdraw it, spend it, or reinvest it. If you choose to reinvest it, you use that cash to purchase additional shares of the same stock or other investments. Most major U.S. brokerages allow you to automate this process through something called a DRIP, or dividend reinvestment plan. When DRIP is enabled, every dividend payment is automatically used to buy additional shares, often fractional shares, of the same stock or fund. This automation matters because it removes friction and emotion from the process. You do not need to decide each quarter whether to reinvest. Happens consistently. Now let's talk about why reinvestment is so powerful. Imagine you invest $10,000 into a portfolio of dividend-paying blue-chip stocks with an average dividend yield of 3%. That means in the first year, you would expect to receive about $300 in dividends, assuming payouts remain stable. If you withdraw that $300 and spend it, your portfolio remains $10,000, excluding price fluctuations. But if you reinvest that $300 through a DRIP, you now own more shares. In year 2, you are no longer earning dividends on just $10,000. You are earning dividends on $10,300, plus or minus any price movement. Then those additional dividends are reinvested again and again. This creates a snowball effect. Compound interest occurs when returns generate additional returns. In the context of dividend investing, dividends buy more shares, those shares produce more dividends, and those dividends buy even more shares. Over time, the growth becomes nonlinear. Let's expand the example with more realistic long-term assumptions. Assume you invest $10,000 into a diversified dividend portfolio yielding 3% annually. Let's also assume the companies in that portfolio grow their dividends at an average rate of 6% per year. Finally, assume the stock prices grow roughly in line with earnings growth over the long run. If you reinvest all dividends and add no additional capital, that $10,000 could grow to approximately $18,000 to $20,000 over 15 years at an average total return of around 6 to 7%. Over 25 years, it could potentially reach $35,000 or more, depending on market conditions and dividend growth consistency. Now consider what happens if you add consistent contributions. If instead of a one-time $10,000 investment, you invest $500 per month into your dividend portfolio and reinvest all dividends, the numbers become far more significant. At an average annual total return of 8%, $500 per month over 30 years could grow to roughly $700,000 to $800,000. A meaningful portion of that growth comes not just from your contributions, but from reinvested dividends compounding over time. This is the quiet mathematics behind financial independence. The key variable here is time. Dividend investing rewards consistency over decades, not months. The first few years may feel slow. Your dividend income might grow from $300 per year to $450 per year. That does not feel transformative. But as your portfolio grows, each percentage increase represents larger absolute dollars. A 6% dividend growth rate on $1,000 of annual income is a $60 increase. On $10,000 of annual income, it is a $600 increase. On $30,000 of annual income, it becomes $1,800 per year. Compounding accelerates as the base grows. Many beginners underestimate this effect because they focus on the early stages. The first 5 years are about building momentum. The next 10 years are about accelerating growth. The final decade before retirement is often where the most dramatic income expansion occurs. This is why starting early matters so much in stock market investing. A 25-year-old who invests consistently in a dividend portfolio has an enormous advantage over someone who waits until 40. The difference is not intelligence or stock-picking skill. It is simply time for compound interest to operate. But even if you start later in life, the principles still apply. The key is understanding that reinvestment during your accumulation phase maximizes long-term total return. Now let's address a practical question. Should you always reinvest dividends? During your working years, when your goal is growth and accumulation, reinvesting dividends through a DRIP often makes sense. It increases your share count automatically and strengthens compounding. However, once you reach a stage where you want to generate passive income to fund expenses, you may choose to stop reinvesting and instead collect dividends as cash. This transition, from reinvestment mode to income mode, is a strategic decision aligned with your financial goals. Another important factor is consistency during market downturns. When markets decline, dividend reinvestment becomes even more powerful. If stock prices fall 20% but the companies maintain their dividends, your reinvested cash buys more shares at lower prices. This increases your future income potential. It can feel uncomfortable to invest during downturns, but mathematically, downturns can accelerate long-term compounding for disciplined investors. This is one reason dividend investing can help investors stay rational during volatility. Instead of viewing a market decline purely as a loss in account value, you can see it as an opportunity to acquire more income-producing assets at a higher dividend yield. Let's illustrate this with numbers. Suppose you own a stock trading at $100 with a $3 annual dividend, yielding 3%. If the stock drops to $75 but the dividend remains $3, the yield rises to 4%. When you reinvest dividends at $75 instead of $100, you acquire more shares per dollar invested. When the stock eventually recovers, you own a larger share base than you would have otherwise. This dynamic strengthens both your income stream and your total return over time. Now let's discuss dividend growth in more detail. Dividend growth is arguably more important than starting yield for long-term investors. Consider two scenarios. Stock A yields 5% but never increases its dividend. Stock B yields 2.5% but increases its dividend by 10% per year. In the first year, Stock A provides more income. But after roughly 8 to 10 years, Stock B's growing dividend may surpass Stock A's fixed payout. Over 20 years, the difference becomes substantial. Dividend growth investing focuses on companies that consistently raise their dividends year after year. This not only increases your income but often reflects underlying earnings growth and financial strength. When dividend growth is combined with dividend reinvestment, you create a dual compounding effect. First, your share count increases due to reinvestment. Second, the dividend per share increases due to corporate growth. This is the foundation of long-term wealth creation through dividend investing for beginners and experienced investors alike. However, discipline is essential. Compounding only works if you remain invested. If you panic during market downturns and sell your holdings, you interrupt the compounding process. If you constantly trade in and out of positions chasing higher yields, you may undermine long-term growth. The power of compound interest rewards patience, not constant activity. One more concept to consider is the difference between yield on cost and current yield. Yield on cost refers to the dividend yield based on your original purchase price. If you bought a stock at $50 with a $2 dividend, your initial yield was 4%. If the dividend grows to $4 per share over time, your yield on cost becomes 8%, even if the stock now trades at $120. This demonstrates how long-term dividend growth can significantly increase your effective income relative to your original investment. Understanding these concepts changes how you evaluate opportunities. Instead of asking only, "What is the dividend yield today?" you begin asking, "What could this dividend become in 10 or 20 years?" That forward-looking perspective separates strategic dividend investors from short-term yield chasers. As we move into the next section, we will shift from theory to application. You understand how dividends work. You understand the power of reinvestment and compound interest. Now the question becomes practical. How do you build your first dividend portfolio? How do you choose between individual blue-chip stocks and dividend-focused ETFs? How do you diversify across sectors? How do you think about position sizing and risk management? Let's begin constructing that portfolio framework next. Part 4. Building your first dividend portfolio. Now that you understand how dividends work and how compound interest accelerates growth through dividend reinvestment, it is time to translate theory into structure. Building your first dividend portfolio is not about randomly selecting a handful of high-yield stocks. It is about constructing a resilient, diversified system designed to generate income, preserve capital, and deliver strong total return over decades. Let's begin with a fundamental principle of stock market investing: diversification. When you buy a single stock, you are exposed to the specific risks of that company. Management mistakes, industry disruption, regulatory changes, litigation, or declining competitive advantage can all impact that one business. If your portfolio depends heavily on a single dividend payer, your income stream becomes fragile. Diversification reduces that fragility. In practical terms, diversification means spreading your investments across different sectors of the economy. In the U.S. stock market, these sectors include areas such as technology, healthcare, consumer staples, financials, industrials, energy, utilities, real estate, and communication services. Each sector responds differently to economic cycles. Consumer staples companies often perform relatively well during recessions because people continue buying basic goods. Utilities tend to provide stable cash flows due to regulated business models. Technology companies may offer higher growth but sometimes greater volatility. Financial firms can be sensitive to interest rates and credit cycles. By building a dividend portfolio that includes multiple sectors, you reduce the likelihood that one economic event will severely damage your entire income stream. For beginners, a reasonable starting framework might involve owning 10 to 20 dividend-paying companies across different industries. This provides diversification without becoming unmanageable. Owning 50 or 100 individual stocks is often unnecessary and can dilute your focus. But there is another option. Instead of selecting individual companies, you can use dividend-focused exchange-traded funds. An ETF is a basket of stocks that trades like a single stock. Some ETFs focus on high dividend yield. Others focus on dividend growth. Others track companies with long histories of increasing dividends. For someone new to dividend investing for beginners, ETFs can provide instant diversification with one purchase. Rather than analyzing each company's payout ratio, earning stability, and debt levels, you rely on the index methodology of the fund. However, ETFs are not inherently superior to individual stocks. They offer convenience and diversification, but they also reduce control. With individual stocks, you can select companies that align precisely with your criteria for dividend growth, payout sustainability, and balance sheet strength. Many experienced investors use a hybrid approach. They own a core dividend ETF for broad diversification and complement it with select blue-chip stocks that they believe offer strong long-term dividend growth potential. Now let's discuss blue-chip stocks. Blue-chip stocks are large, established companies with long track records of profitability and often consistent dividend payments. They typically have strong brand recognition, durable competitive advantages, and global operations. In dividend investing, blue-chip stocks are often attractive because they combine stability with reliable income. They are not immune to downturns, but their scale and financial strength can make their dividends more resilient than smaller, less established firms. When constructing your dividend portfolio, the goal is not to maximize yield. The goal is to balance income, growth, and risk. This brings us to position sizing. Position sizing refers to how much of your portfolio you allocate to any single investment. If you invest 25% of your portfolio into one stock and that company cuts its dividend, your income drops dramatically. If instead that position represents 5% of your portfolio, the impact is more manageable. For beginners, keeping individual stock positions between 3 and 8% of the portfolio is often a reasonable starting range, depending on conviction and diversification. The exact percentage is less important than the principle. No single company should be capable of crippling your dividend portfolio. Now let's introduce an essential concept: total return versus income focus. Many new investors in dividend investing focus exclusively on dividend yield. They search for stocks yielding 6%, 8%, or even higher. But yield alone does not determine long-term success. Total return includes both dividend income and capital appreciation. If you own a stock yielding 3% that grows in price by 7% annually, your total return is roughly 10% before compounding. If you own a stock yielding 8% but its price declines 5% annually due to deteriorating business conditions, your total return may be far lower, and your capital base may erode. This is why focusing only on passive income without regard to underlying business performance can be dangerous. A healthy dividend portfolio balances current yield with long-term growth potential. Companies that increase earnings steadily are more likely to grow dividends. And companies that grow dividends consistently often experience share price appreciation over time, supporting total return. In other words, income and growth are not mutually exclusive. In strong businesses, they reinforce each other. Let's walk through a simplified example of building a dividend portfolio from scratch. Suppose you have $50,000 to invest. Instead of placing it all into one high-yield stock, you decide to construct a diversified portfolio. You might allocate across several sectors: consumer staples, healthcare, financials, industrials, utilities, and technology. Within each sector, you select one or two financially stable companies with moderate payout ratios and a history of dividend growth. Alternatively, you might place $25,000 into a broad dividend growth ETF and divide the remaining $25,000 among 5 individual blue-chip stocks you have researched carefully. The objective is not perfection. It is resilience. Over time, you will likely adjust your portfolio. You may add new positions as you contribute additional capital. You may trim positions that become disproportionately large due to price appreciation. You may replace companies whose fundamentals deteriorate. Dividend investing is not static. It evolves with your knowledge and with economic conditions. Another important consideration is rebalancing. Rebalancing means periodically adjusting your portfolio to maintain your target allocations. For example, if one sector grows rapidly and becomes 30% of your portfolio when you originally intended it to be 15%, you may decide to reduce exposure and reallocate to underweight areas. This process helps manage risk and prevents your dividend portfolio from becoming unintentionally concentrated. Let's also address the role of cash and bonds. While this masterclass focuses on dividend investing within equities, many investors include other asset classes for stability. Bonds can provide lower volatility and predictable income, though typically at lower yields. Cash provides liquidity and optionality. Your dividend portfolio does not need to represent 100% of your investable assets, especially as you approach retirement. Asset allocation should align with your risk tolerance and time horizon. Speaking of time horizon, this is critical. If you are in your 20s or 30s, your dividend portfolio is likely in accumulation mode. You are reinvesting dividends and contributing additional capital regularly. Volatility is less threatening because your income stream is still relatively small compared to future potential. If you are in your 50s or 60s, you may be transitioning toward income mode. You may prioritize stability and dividend reliability over aggressive growth. Your strategy should reflect your stage of life. Now, as you build your first dividend portfolio, you will inevitably encounter thousands of potential stocks. The U.S. market alone includes hundreds of dividend-paying companies. How do you decide which ones are worth owning? This is where analysis becomes essential. In the next section, we will move beyond portfolio structure and dive deeply into how to analyze dividend stocks properly. You will learn how to evaluate earnings stability, free cash flow, debt levels, dividend history, and payout sustainability. You will also learn how to identify warning signs of dividend traps, stocks that appear attractive due to high yield but carry hidden risks. Constructing a dividend portfolio is only as strong as the businesses inside it. Let's learn how to evaluate those businesses with precision. Part 5. How to analyze dividend stocks. Building a diversified dividend portfolio is only the beginning. The quality of your results will depend on the quality of the businesses you own. Dividend investing for beginners becomes far more powerful when you understand how to evaluate companies beyond the surface-level dividend yield. This is where we move from basic participation in the stock market to informed ownership. When analyzing dividend stocks, there are 5 core areas you should consistently evaluate: earnings stability, free cash flow, debt levels, dividend history, and payout ratio sustainability. Together, these factors help you determine whether a dividend is reliable or vulnerable. Let's begin with earnings stability. Dividends are paid from profits. If a company's earnings are volatile, unpredictable, or declining over time, its dividend is inherently less secure. Stable and growing earnings provide the foundation for stable and growing dividends. When reviewing a company, look at its earnings per share over the past 5 to 10 years. Has it grown steadily? Were there sharp declines during recessions? Did earnings recover quickly? Companies in defensive sectors such as consumer staples and utilities often exhibit more stable earnings patterns. Companies in cyclical industries such as energy or materials may experience large swings tied to commodity prices or economic conditions. Neither category is inherently good or bad, but you must understand the pattern. A cyclical business paying a high dividend during a peak earnings year may be unsustainable when the cycle turns downward. Consistency matters. Next, examine free cash flow. Net income is an accounting measure. Free cash flow represents actual cash generated by the business after capital expenditures. Dividends are paid in cash, not accounting profits. A company can report positive earnings but struggle with cash flow if its capital requirements are high or if receivables are not converting efficiently into cash. Free cash flow provides a clearer picture of dividend sustainability. If a company consistently generates free cash flow well in excess of its dividend payments, that is a positive sign. If dividends consume nearly all free cash flow, or worse, exceed it, risk increases. Some companies temporarily fund dividends through debt during downturns, but this cannot continue indefinitely. Sustainable dividends are backed by durable cash generation. Now let's discuss debt levels. Debt can amplify returns when managed prudently, but excessive debt increases financial risk. During economic downturns, companies with heavy debt burdens may be forced to prioritize interest payments over dividends. When analyzing a dividend stock, examine metrics such as debt-to-equity ratio and interest coverage ratio. Interest coverage measures how easily a company can pay interest expenses from operating income. Higher coverage ratios indicate stronger financial flexibility. A company with modest debt and strong cash flow is more likely to maintain dividends during recessions than one operating with thin margins and high leverage. This brings us to dividend history. While past performance does not guarantee future results, a long history of consistent dividend payments, and especially dividend growth, demonstrates management commitment and business resilience. Some companies have increased their dividends annually for decades. This consistency often reflects strong corporate culture, disciplined capital allocation, and durable competitive advantages. Dividend growth over time is especially powerful. If a company has raised its dividend for 10, 20, or even 30 consecutive years, it has likely navigated multiple economic cycles successfully. However, do not rely solely on history. Even companies with long track records can encounter structural disruption. You must combine historical performance with forward-looking analysis of the business model. Now let's return to the payout ratio, but with greater nuance. Earlier we defined payout ratio as the percentage of earnings paid out as dividends. Here we evaluate sustainability. A payout ratio that is too low may indicate the company is reinvesting heavily and has room to grow dividends. A moderate payout ratio often signals balance. A very high payout ratio, especially above 80% in most industries, suggests limited flexibility. But context is critical. Utilities and certain infrastructure businesses often operate with stable cash flows and regulated returns, allowing for higher payout ratios. Real estate investment trusts are required by law to distribute a significant portion of taxable income, resulting in structurally higher payout ratios. In contrast, technology companies or cyclical industrial firms generally require more reinvestment and may need lower payout ratios to maintain flexibility. The key question is not, is the payout ratio high? But rather, is it sustainable given this business model? Now let's discuss one of the most important risks in dividend investing. Dividend traps. A dividend trap occurs when a stock appears attractive because of a very high dividend yield, but underlying business fundamentals are deteriorating. The high yield often results from a declining stock price rather than increasing dividends. Imagine a company trading at $50 with a $3 dividend, yielding 6%. If the business begins losing market share and earnings decline, investors may sell the stock. The price falls to $30. The dividend remains temporarily at $3, and the yield now appears to be 10%. To an uninformed investor, this looks like an opportunity. In reality, it may signal distress. If earnings continue falling, management may be forced to cut the dividend. When that cut is announced, the stock price often drops further, compounding losses. This is why chasing yield without analyzing earnings and cash flow can be dangerous. In dividend investing for beginners, it is tempting to screen for the highest yields and assume higher yield equals higher income potential. In reality, sustainable dividend growth and financial strength often matter more than headline yield. Let's walk through a practical evaluation framework. Suppose you are analyzing a company yielding 4%. You observe that earnings have grown steadily at 5% annually over the past decade. Free cash flow covers the dividend comfortably, with a payout ratio around 50%. Debt levels are moderate, and interest coverage is strong. The company has increased its dividend for 15 consecutive years. This profile suggests balance. Reasonable yield, consistent growth, manageable debt, and a sustainable payout ratio. Now compare that to a company yielding 9%. Earnings have declined in 3 of the past 5 years. Free cash flow barely covers the dividend. The payout ratio exceeds 90%. Debt levels are high. Dividend growth has stalled. The second company may appear attractive based solely on yield, but risk is significantly higher. Over time, companies with stable earnings and sustainable payout ratios often deliver superior total return compared to those offering unsustainably high yields. It is also important to evaluate the competitive position of the business. Does the company have a durable advantage? Strong brand recognition, cost leadership, intellectual property protection, network effects. Dividend stability ultimately depends on business strength. You are not buying dividends. You are buying businesses that pay dividends. As your experience grows, you will become more comfortable reading financial statements, reviewing quarterly reports, and analyzing trends. In the beginning, focus on consistency, sustainability, and financial discipline. Remember that dividend investing is not about maximizing income this year. It is about building a reliable and growing income stream over decades. This leads naturally into an important strategic question. Should you focus on high dividend yield today, or lower yield with higher dividend growth over time? Should your dividend portfolio emphasize immediate income, or long-term compounding? In the next section, we will compare dividend growth versus high-yield strategies in detail. You will see the trade-offs clearly, understand the risks of chasing high yield, and learn how sustainable dividend growth can accelerate your path toward financial independence. Let's examine that strategic choice next. Part 6. Dividend growth versus high-yield strategy. Now we arrive at one of the most important strategic decisions in dividend investing for beginners. Should you prioritize high dividend yield today, or focus on companies that offer lower yield but strong dividend growth over time? This is not a purely mathematical question. It is also psychological. It depends on your time horizon, income needs, and tolerance for volatility. Let's define the two approaches clearly. A high-yield strategy focuses on stocks that currently pay above-average dividend yields, often in the range of 5%, 6%, or higher. The primary goal is maximizing immediate passive income from a given amount of capital. A dividend growth strategy focuses on companies with moderate yields, often 2% to 4%, but strong, consistent annual increases in their dividend payments. The goal is building a rising income stream that compounds significantly over time. Both approaches can work. Both carry risk. The key is understanding the trade-offs. Let's begin with the appeal of high yield. If you invest $100,000 into a portfolio yielding 6%, you generate $6,000 per year in dividend income. If your portfolio yields 3%, that same $100,000 produces only $3,000 per year. For investors nearing retirement, this difference feels substantial. Higher yield means less capital required to reach a given income target. For someone seeking financial independence in the near term, this can be attractive. However, higher yield often comes with higher risk. Why? Because in efficient markets, unusually high dividend yields often reflect underlying concerns about the business. The stock price may have declined due to earnings pressure, competitive threats, regulatory issues, or industry disruption. In some cases, the dividend may be sustainable. In other cases, it may be vulnerable to a cut. Dividend cuts are particularly damaging in a high-yield strategy. Not only does your income decline, but stock prices often fall sharply when a cut is announced. This double impact, lower income and lower capital value, can be painful. Now consider the dividend growth approach. Imagine a company yielding 2.5% today but increasing its dividend by 8% annually. In the first year, a $100,000 investment produces $2,500 in income. That may seem modest compared to $6,000 from a high-yield portfolio. But after 10 years of 8% annual growth, that dividend income could grow to over $5,400 per year, assuming no additional contributions and consistent growth. After 20 years, it could exceed $11,000 per year. Meanwhile, companies capable of sustained dividend growth often experience earnings growth as well, which can support rising stock prices and strong total return. The dividend growth strategy relies heavily on time and compound interest. In the early years, income appears modest. Over time, growth accelerates. Yield on cost increases. Your effective income relative to your original investment becomes substantial. This is why dividend growth investing is often favored by younger investors with long time horizons. Now let's introduce a key concept. Sustainability. Sustainable dividend growth typically comes from companies with strong competitive positions, healthy balance sheets, and disciplined capital allocation. These businesses are not stretching to maintain payouts. They are increasing dividends because earnings are rising. In contrast, some high-yield companies distribute a large percentage of earnings, sometimes 80%, 90%, or even more. When economic conditions weaken, there is little buffer. This is where payout ratio becomes critical. A company yielding 7% with a payout ratio of 95% is inherently more fragile than one yielding 3% with a payout ratio of 45% and consistent earnings growth. Now let's discuss dividend aristocrats. Dividend aristocrats are companies that have increased their dividends for at least 25 consecutive years. These firms have navigated multiple recessions, interest rate cycles, and economic disruptions while continuing to reward shareholders. While not all dividend aristocrats are perfect investments, the discipline required to increase dividends for decades often reflects strong underlying business fundamentals. Dividend growth investors frequently gravitate toward these types of companies because they demonstrate resilience and commitment to shareholders. However, even dividend aristocrats can face challenges. Industry disruption, technological change, or poor capital allocation decisions can alter long-term prospects. No company is immune to change. Now let's compare risk profiles more directly. High-yield portfolios often concentrate in sectors such as energy, real estate, telecommunications, and utilities. These sectors can provide strong income but may be sensitive to interest rates, commodity prices, or regulatory shifts. Dividend growth portfolios often include more exposure to consumer brands, healthcare firms, industrial leaders, and certain technology companies with expanding cash flows. Neither allocation is universally superior. The difference lies in volatility and long-term income trajectory. High-yield strategies may produce more stable immediate income but can experience sharper dividend cuts during downturns if underlying fundamentals weaken. Dividend growth strategies may deliver lower income initially but potentially higher income and capital appreciation over decades. Let's illustrate with a realistic scenario. Investor A chooses a portfolio yielding 6% with no dividend growth. Investor B chooses a portfolio yielding 3% with 7% annual dividend growth. If both invest $200,000, Investor A begins with $12,000 in annual income. Investor B begins with $6,000. After 10 years, Investor A still earns roughly $12,000 annually, assuming dividends remain flat. Investor B's income, growing at 7% annually, rises to approximately $11,800 per year, nearly matching Investor A. After 15 years, Investor B's income surpasses $16,500 per year, significantly exceeding Investor A's static income. Meanwhile, if Investor B's companies also experience price appreciation aligned with earnings growth, total return may further widen the gap. But what if Investor A needs income immediately? This is where personal circumstances matter. An investor already in retirement may prioritize current income and accept lower growth. A 30-year-old professional building toward financial independence may favor dividend growth and reinvestment. Many experienced investors adopt a blended strategy. They allocate part of their dividend portfolio to moderate yield, stable companies and part to higher growth dividend payers. This creates balance. Reasonable current income with long-term growth potential. The key is avoiding yield chasing. Yield chasing occurs when investors pursue the highest available dividend yield without analyzing sustainability. It often leads to concentration in distressed companies or sectors with structural decline. A disciplined dividend strategy always evaluates earning stability, payout ratio, debt levels, and competitive positioning before focusing on yield. Another important factor is inflation. Inflation erodes purchasing power over time. A static 6% dividend that never grows may lose real value if inflation averages 3% annually. In contrast, a dividend growing at 7% per year outpaces inflation and increases real income. Dividend growth therefore provides a hedge against rising living costs, which is particularly important for long-term financial independence. Now consider behavioral psychology. High-yield portfolios may appear comforting because they produce larger cash deposits immediately. But if a dividend cut occurs, the emotional impact can lead to reactive decisions. Dividend growth portfolios may test patience in the early years, but rising income over time reinforces discipline and confidence. Ultimately, the right strategy depends on your time horizon, risk tolerance, and income needs. If you are decades away from relying on passive income, emphasizing dividend growth and reinvestment often aligns with compound interest and long-term total return. If you are closer to retirement or already drawing income, a balanced allocation that includes moderate yield stable payers may make sense. But regardless of strategy, one critical variable influences your net income more than many beginners realize. Taxes. In the United States, dividends are not taxed uniformly. The distinction between qualified dividends and ordinary dividends can significantly affect your after-tax income. The type of account you use, taxable brokerage, Roth IRA, or 401k, also changes the equation. In the next section, we will examine how dividend taxation works in the U.S., how to structure your accounts for tax efficiency, and how to think strategically about placement of dividend-paying assets. Understanding taxes ensures that more of your dividend income remains in your portfolio rather than going to the IRS. Let's explore that framework next. Part 7. Taxes and Accounts, U.S. Focus. As your dividend portfolio grows, one factor becomes increasingly important: taxes. You can build a disciplined strategy, select strong blue-chip stocks, focus on dividend growth, and reinvest consistently. But if you ignore tax efficiency, you may be unnecessarily reducing your net passive income. In the United States, dividends are taxed differently depending on the type of dividend and the type of account in which you hold the investment. Understanding these distinctions is essential for maximizing long-term total return and protecting your path toward financial independence. Let's begin with the two primary categories of dividends in taxable brokerage accounts: qualified dividends and ordinary dividends. Qualified dividends receive favorable tax treatment. They are taxed at the long-term capital gains rate, which is typically lower than ordinary income tax rates. For most investors, qualified dividends are taxed at 0%, 15%, or 20%, depending on income level. Ordinary dividends, on the other hand, are taxed at your regular income tax rate. For many investors, this rate is significantly higher than the long-term capital gains rate. So what determines whether a dividend is qualified? In general, dividends paid by U.S. corporations or qualified foreign corporations are considered qualified dividends if you meet certain holding period requirements. Specifically, you must hold the stock for more than 60 days during the 121-day period surrounding the ex-dividend date. Most traditional dividend-paying U.S. companies distribute qualified dividends, but there are exceptions. Real estate investment trusts, certain master limited partnerships, and some special distributions may not qualify for favorable tax treatment. Why does this matter? Let's look at a simplified example. Suppose you receive $10,000 in annual dividends in a taxable brokerage account. If those dividends are qualified and you are in the 15% capital gains bracket, you pay $1,500 in federal taxes, leaving $8,500. If those same dividends are taxed as ordinary income at a 24% marginal tax rate, you pay $2,400 in federal taxes, leaving $7,600. Over decades, that difference compounds. Now let's examine how account types affect dividend taxation. There are three common account types used in U.S. stock market investing: taxable brokerage accounts, traditional retirement accounts such as 401(k)s and traditional IRAs, and Roth accounts such as Roth IRAs and Roth 401(k)s. Each has different tax characteristics. In a taxable brokerage account, dividends are taxed in the year they are received. You do not receive tax deferral. Whether you reinvest through a DRIP or withdraw the cash, the IRS still considers it taxable income. This makes taxable accounts less efficient for high-yield strategies that generate large amounts of current income. However, taxable accounts offer flexibility. There are no required minimum distributions, and you can access funds at any time without early withdrawal penalties. Next, consider traditional 401(k)s and traditional IRAs. In these accounts, dividends are not taxed when received. The investments grow tax-deferred. You pay taxes only when you withdraw funds in retirement, and withdrawals are taxed as ordinary income. This structure can be beneficial if you expect to be in a lower tax bracket during retirement. However, withdrawals before age 59.5 typically incur penalties unless specific exceptions apply. Roth IRAs and Roth 401(k)s operate differently. In Roth accounts, contributions are made with after-tax dollars. However, once inside the account, investments grow tax-free. Qualified withdrawals in retirement are not taxed at all. For dividend investors, Roth accounts can be particularly powerful. If you hold dividend-paying stocks inside a Roth IRA, you do not pay taxes on qualified dividends, and future withdrawals are also tax-free, provided you meet eligibility requirements. This means all dividend reinvestment compounds without annual tax drag. Now let's discuss asset location. Asset location refers to strategically placing different types of investments in different types of accounts to optimize tax efficiency. For example, High-yield dividend stocks that generate substantial ordinary income may be more tax-efficient inside tax-advantaged accounts such as traditional IRAs or Roth IRAs. This shields dividends from annual taxation. Meanwhile, lower-yield dividend growth stocks that primarily produce qualified dividends might be reasonable to hold in taxable accounts, especially if you are in a lower capital gains bracket. Similarly, investments that generate non-qualified income, such as certain real estate investment trusts, are often more tax-efficient inside retirement accounts. This strategic placement can meaningfully increase your after-tax total return over time. Now consider long-term financial independence. If your goal is to build a dividend portfolio that eventually replaces your employment income, the tax structure of your accounts will directly influence how much capital you need. For instance, if you need $60,000 per year in retirement and your dividend income is taxed at 15%, you need more gross income than if that income is coming from a Roth IRA and is tax-free. Tax planning and dividend investing are interconnected. Another important consideration is required minimum distributions. Traditional 401(k)s and traditional IRAs require you to begin withdrawing a certain percentage of the account each year starting at age 73 under current U.S. law. These withdrawals are taxable as ordinary income. If your dividend portfolio is inside a traditional retirement account, required distributions may exceed your income needs, potentially pushing you into a higher tax bracket. Roth IRAs do not have required minimum distributions during the account holder's lifetime. This provides greater flexibility for managing taxable income in retirement. Now let's address state taxes. In addition to federal taxes, many states tax dividend income. The rules vary by state. Some states do not impose income tax, while others tax dividends at rates similar to ordinary income. Your geographic location therefore influences your net passive income. This is why a comprehensive dividend investing strategy must consider more than yield and growth. It must consider after-tax income. Let's walk through a simplified long-term example. Part 8. Risk management and market crashes. No discussion of dividend investing for beginners would be complete without addressing risk. Markets decline. Recessions occur. Entire industries face disruption. Even well-established blue-chip stocks can experience significant price volatility. If your strategy depends on dividend income, you must understand what happens during economic stress and how to respond with discipline rather than emotion. Let's begin with a fundamental reality. Stock prices are volatile. Dividends are not guaranteed. During a market crash, stock prices can decline 20%, 30%, or even 50% in extreme circumstances. However, dividend payments do not automatically fall at the same rate as stock prices. In fact, in many cases, dividends remain stable even while prices fluctuate dramatically. This distinction is crucial. Market volatility affects the market value of your portfolio. Dividend cuts affect your income stream. The two are related but not identical. For example, during a recession, investors may panic and sell shares across the board. Prices decline rapidly due to fear and uncertainty. But if the underlying businesses continue generating sufficient cash flow, they may maintain their dividend payments. In such cases, dividend yield actually rises because the stock price falls while the dividend remains constant. However, not all companies can maintain dividends during economic downturns. Companies in cyclical industries such as energy, travel, hospitality, or heavy manufacturing may experience sharp declines in revenue during recessions. If profits fall significantly, management may choose or be forced to reduce or suspend dividend payments to preserve cash. This is why risk management begins long before a recession occurs. The strength of your dividend portfolio during a crash depends largely on the quality of the businesses you selected during stable times. Let's examine what typically happens during recessions. Economic activity slows. Consumer spending may decline. Corporate profits shrink. Credit conditions tighten. Investors become more risk-averse. In response, some companies cut costs, reduce capital expenditures, and protect balance sheets. Others may struggle under high debt loads or thin profit margins. Companies with strong balance sheets, moderate payout ratios, diversified revenue streams, and durable competitive advantages are generally better positioned to maintain dividends during downturns. Companies with excessive leverage, high payout ratios, or fragile business models face greater pressure. This is why earlier we emphasized earnings stability, free cash flow coverage, and manageable debt levels. Those metrics are not academic exercises. They are risk indicators. Now let's discuss dividend cuts more directly. When a company announces a dividend cut, two things usually happen. First, your income from that position declines. Second, the stock price often drops sharply, reflecting investor disappointment and reassessment of the company's prospects. This can be discouraging, especially for investors relying on passive income. However, a dividend cut does not automatically mean permanent loss. Some companies reduce dividends temporarily to strengthen their balance sheets, then resume growth later. Others may be undergoing structural decline, in which case recovery may be limited. The key question is whether the underlying business remains viable and capable of generating sustainable cash flow in the future. Risk management in dividend investing involves ongoing evaluation. If a company's fundamentals deteriorate significantly, declining earnings, rising debt, shrinking competitive advantage, you must decide whether holding the position still aligns with your long-term strategy. This does not mean reacting emotionally to every price decline. Price volatility alone is not a sufficient reason to sell. Instead, focus on fundamentals. Now let's address a psychological challenge. When markets decline sharply, it is tempting to abandon long-term plans. Headlines become negative. Economic forecasts turn pessimistic. Portfolio values drop rapidly. But for long-term dividend investors who are reinvesting through a drip, downturns can create opportunity. If dividends remain intact, reinvested cash purchases more shares at lower prices. This increases future income potential. In effect, volatility can accelerate compounding for disciplined investors. Consider a simple scenario. You own a diversified dividend portfolio yielding 3.5%. The market declines 25% during a recession. Your portfolio value drops accordingly. But the majority of your companies maintain their dividends. Your yield, based on current price, rises above 4%. Each reinvested dividend buys more shares than it did before the downturn. When markets recover over the following years, your larger share base amplifies both income and total return. This requires emotional resilience. Dividend investing encourages a long-term mindset precisely because it shifts focus from daily price movement to ongoing income production. Instead of asking, "What is my portfolio worth today?" you can ask, "Are my businesses still generating cash and paying dividends?" Now let's discuss sector-specific risk. No sector is immune to disruption. Technology changes. Consumer preferences evolve. Regulatory environments shift. Even historically stable sectors can face unexpected challenges. For example, financial institutions can suffer during credit crises. Energy companies can struggle during commodity price collapses. Retailers can decline due to e-commerce disruption. Diversification across sectors reduces the impact of any one industry downturn on your overall dividend portfolio. Additionally, geographic diversification matters. Many large U.S. companies generate revenue globally. This provides some insulation from domestic economic weakness. Another important risk factor is inflation. High inflation can pressure profit margins, increase borrowing costs, and reduce consumer purchasing power. Companies with pricing power, those able to pass higher costs to customers, are generally better positioned to maintain earnings and dividend growth during inflationary periods. This is why evaluating competitive advantage is part of risk management. Now let's examine concentration risk. If 40% of your dividend income comes from one company or one sector, your portfolio is vulnerable. A single dividend cut could materially impact your passive income. Maintaining balanced position sizes and sector allocations reduces this risk. You may also consider maintaining a modest cash buffer or fixed income allocation, particularly if you are already drawing income from your portfolio. This buffer can reduce the need to sell equities during market downturns. For investors pursuing financial independence, sequence of returns risk becomes relevant. If you retire and immediately experience a severe market downturn, withdrawing from a depressed portfolio can have lasting impact. In such cases, relying solely on dividend income, rather than selling shares, can mitigate some risk, provided dividends remain stable. This is one reason many income-focused investors favor dividend-paying stocks over purely growth-oriented assets in retirement. But discipline remains critical. Market crashes are uncomfortable. They test conviction. The key is preparing in advance. Preparation involves selecting financially strong companies, diversifying thoughtfully, maintaining sustainable payout ratios, and aligning your asset allocation with your risk tolerance. It also involves realistic expectations. Dividend investing is not immune to loss. Stock prices will fluctuate. Some companies will disappoint. The goal is not perfection. The goal is resilience over decades. If you approach dividend investing with a long time horizon, volatility becomes less threatening. Recessions become part of the cycle rather than catastrophic events. Now that we have examined risk and volatility, we can turn toward planning. Understanding dividends, compounding, portfolio construction, tax efficiency, and risk management gives you the tools. The next step is applying those tools to design a practical dividend income plan. How much passive income do you actually need? How much capital does it take to generate that income at various dividend yields? What timeline is realistic for reaching financial independence through dividend investing? In the next section, we will construct a structured dividend income plan using realistic U.S. numbers and clear projections. It is time to translate knowledge into actionable financial architecture. Part 9. Creating a dividend income plan. At this point in the masterclass, you understand how dividends work, how compound interest accelerates growth, how to analyze dividend stocks, how to manage risk, and how taxes affect your net passive income. Now we shift from theory to planning. Dividend investing for beginners becomes powerful when it moves from abstract ideas to specific numbers tied to your life. A dividend income plan answers 3 essential questions. How much passive income do I need? How much capital is required to generate that income? How long will it realistically take to get there? Let's start with the first question. How much income do you actually need? Financial independence is often defined as the point at which your investment income covers your living expenses. That number is different for everyone. If your annual expenses are $40,000, your target income differs dramatically from someone whose expenses are $100,000 per year. The process begins with clarity about your personal cost of living. For illustration, let's work with 3 hypothetical targets: $30,000, $60,000, and $100,000 per year in dividend income. Now we connect income targets to dividend yield. Dividend yield determines how much capital is required to generate a given level of income. The formula is straightforward. Required capital equals desired annual income divided by dividend yield. If your portfolio yields 3%, and you want $30,000 per year, you divide $30,000 by 0.03. The result is $1 million. At a 4% yield, $30,000 per year requires $750,000. At a 5% yield, $30,000 per year requires $600,000. Now apply the same logic to $60,000 per year. At 3% yield you would need $2 million. At 4% yield, $1,500,000. At 5% yield, $1,200,000. For $100,000 per year. At 3% yield, approximately $3.33 million. At 4% yield, $2.5 million. At 5% yield, $2 million. These numbers are not meant to discourage you. They are meant to provide clarity. Dividend investing is powerful, but it requires capital and time. The path to financial independence through dividends is built gradually through consistent contributions and compounding. Now let's introduce growth into the equation. If your dividend portfolio grows its income over time, your required starting yield does not need to be extremely high. For example, suppose you aim for $60,000 per year in dividend income 25 years from now. Instead of targeting a static 5% yield, you could build a dividend growth portfolio yielding 3% today but increasing dividends at 6 to 8% annually. Over 25 years, that growth dramatically increases income per dollar invested. This is where the concept of yield on cost becomes meaningful. A stock yielding 3% today may effectively yield 8% or more on your original investment decades later if dividend growth is consistent. Now let's consider accumulation timelines. Suppose you invest $1,000 per month into a diversified dividend portfolio earning an average total return of 8% annually, including dividend reinvestment. After 10 years, your portfolio might grow to roughly $180,000 to $190,000. After 20 years, approximately $590,000. After 30 years, around $1.5 million. At that point, with a 3.5% average dividend yield, you could potentially generate more than $50,000 per year in dividend income. These are simplified projections and assume consistent returns, which never occur in a straight line. But they illustrate the power of long-term compounding combined with disciplined contributions. Now consider the impact of increasing contributions over time. If you start investing $500 per month in your 20s, increase to $1,000 per month in your 30s, and perhaps $1,500 per month in your 40s as income rises, the compounding effect accelerates significantly. Financial independence through dividend investing is rarely achieved by yield alone. It is achieved by a combination of consistent capital contributions, reinvestment of dividends, sustainable dividend growth, patience over decades. Now let's discuss realistic expectations. Dividend investing is not a shortcut to early retirement within 5 years starting from zero. Without substantial starting capital, building meaningful passive income takes time. However, time is an advantage when you begin early. A 25-year-old investing consistently for 35 years benefits from an enormous compounding window. A 45-year-old investor has less time but may have higher income to contribute larger amounts. The key variable you control is savings rate. Higher savings rates shorten the timeline dramatically. A person saving 30% of their income will reach financial independence far faster than someone saving 5%, even with similar investment returns. Dividend investing amplifies savings discipline. Each invested dollar becomes a small income-producing asset. As your dividend income grows, you may find motivation in watching that income rise year after year. Now let's consider transition strategy. During your accumulation years, you reinvest dividends through a drip. Your focus is total return and income growth. As you approach your target income level, you gradually shift from reinvestment mode to distribution mode. Instead of automatically reinvesting, you begin directing dividends into cash flow to cover expenses. This transition should be planned thoughtfully. Ideally, you reach a point where dividend income covers core living expenses before you rely on it entirely. Another important concept is margin of safety. If your annual expenses are $60,000, you may prefer generating $70,000 in dividend income to provide buffer against unexpected costs, inflation, or dividend reductions. Financial independence is more secure when income exceeds essential expenses rather than matching them exactly. Now let's discuss inflation more directly. If inflation averages 3% per year, your purchasing power declines over time. A $60,000 lifestyle today may require $90,000 or more in 20 years. Dividend growth investing addresses this challenge by increasing income over time. Companies that consistently raise dividends can help offset inflationary pressure. This is why a pure high-yield strategy with no growth may not fully protect long-term purchasing power. Now consider psychological readiness. Financial independence is not merely a numerical target. It is a mindset shift from earning income through labor to earning income through ownership. Dividend investing reinforces this shift. Each quarterly payment represents profit distribution from businesses you own. However, reaching a target portfolio value does not eliminate risk. Markets will continue fluctuating. Companies will continue evolving. Ongoing monitoring remains necessary, though not obsessively. The purpose of a dividend income plan is clarity. When you know your target income, required capital, expected yield, and contribution strategy, uncertainty becomes manageable. Instead of asking vague questions like, "Am I investing enough?" you can calculate progress objectively. You can review your annual dividend income each year and compare it to your target. If your income grows from $5,000 to $6,200 to $7,800, you see measurable advancement toward financial independence. That visibility reinforces discipline. Now that we have built a concrete income framework, we can move into the final section of this masterclass. In Part 10, we will bring everything together into a cohesive long-term wealth strategy. We will clarify the difference between wealth and income, emphasize the role of discipline and patience, and outline how your dividend portfolio evolves over decades. Dividend investing is not a tactic. It is a system. Let's complete that system in the final part. Part 10, Long-Term Wealth Strategy and Final Framework. We've covered mechanics, math, psychology, taxes, risk, portfolio construction, and income planning. Now we bring everything together into a unified long-term wealth strategy. Dividend investing for beginners often starts with one simple idea: getting paid to own stocks. But over time, that idea matures into something far more powerful: ownership of durable businesses that generate growing streams of cash flow. The final step is understanding how dividend investing fits into your broader financial life over decades. First, we need to clarify something fundamental. Income is not the same as wealth. Dividend income feels tangible. It arrives in your account quarterly. You can see it increase year after year. But true wealth is your ownership stake in productive assets, the underlying businesses themselves. A strong dividend portfolio should do two things simultaneously: generate reliable income, increase in value over time. This is the concept of total return. Total return combines dividend income and capital appreciation. If your portfolio yields 3% but grows in value by 5% annually, your total return is 8%. Over long time horizons, total return is what determines whether your wealth compounds meaningfully. If you focus only on yield and ignore business quality or growth, you may sacrifice total return. That can slow long-term wealth creation and even erode purchasing power. On the other hand, if you focus only on growth and ignore income entirely, you may eventually face psychological stress when markets decline and no cash flow is generated. The balance between growth and income is what makes dividend investing such a powerful framework for stock market investing. Now let's outline the life cycle of a dividend investor. Stage 1 is accumulation. In this stage, you are building capital aggressively. You reinvest all dividends through DRIP. Your focus is expanding ownership, accumulating shares of high-quality companies or diversified dividend ETFs. Market downturns are opportunities because lower prices allow you to purchase more shares. Stage 2 is expansion and refinement. Your portfolio is now substantial. Dividend income becomes meaningful, perhaps covering certain bills or discretionary expenses. You may refine holdings, trimming weaker positions and adding stronger businesses. Dividend growth becomes increasingly important because rising income reinforces financial progress. Stage 3 is transition. You approach your financial independence number. You may stop reinvesting all dividends and instead direct a portion toward living expenses. At this stage, capital preservation becomes more important. You prioritize stability, diversified sectors, and sustainable payout ratios. Stage 4 is distribution with resilience. Dividend income covers your core expenses. You still monitor business fundamentals. You may rebalance occasionally, but your portfolio functions as a cash flow engine supporting your lifestyle. Throughout all stages, discipline is the unifying principle. Discipline in saving consistently. Discipline in analyzing businesses carefully. Discipline in ignoring short-term noise. Discipline in reinvesting during downturns. Financial markets are volatile. Headlines will always create urgency. But dividend investing is built on decades, not days. Let's revisit the mindset shift that makes this strategy sustainable. When you buy a share of a strong company, you are becoming a partial owner of its earnings. If that company earns billions in profit, pays a portion as qualified dividends, and reinvests the rest to grow future profits, you participate in that cycle. Over time, dividend growth reflects rising corporate earnings. Rising earnings often support rising stock prices. And rising stock prices expand your net worth. This cycle is how ordinary investors build extraordinary wealth over 20 or 30 years. Now consider inflation again. Inflation is silent but relentless. Cash sitting idle loses purchasing power. Businesses, however, can raise prices, innovate, expand markets, and adapt. Owning productive businesses is one of the most effective long-term hedges against inflation. Dividend growth amplifies that protection because it increases your income stream over time. Next, we must acknowledge uncertainty. No company is permanent. Even blue-chip stocks can decline if management makes poor decisions or industries change dramatically. That is why diversification remains critical throughout your journey. A strong dividend portfolio spans multiple sectors: healthcare, consumer staples, industrials, utilities, technology, energy, and more. No single holding should determine your financial future. Now let's address a common question. Can dividend investing alone achieve financial independence? The answer depends on savings rate, time horizon, and lifestyle expectations. For some investors, dividend income will be one component of a broader strategy that includes Social Security, retirement accounts like 401(k)s, real estate, or other investments. For others, dividend investing becomes the primary engine of passive income. There is no single correct structure. What matters is alignment between your portfolio and your long-term goals. Another essential principle is adaptability. Your strategy at age 25 will not look identical at age 55. Income needs evolve. Risk tolerance changes. Tax considerations shift. But the core framework, owning productive assets that generate growing income, remains intact. Consistency compounds. Not just compound interest in the mathematical sense, but behavioral compounding. Each year you remain disciplined, your confidence grows. Each market cycle you endure strengthens your conviction. Each dividend increase reinforces the power of patience. Over 30 years, that behavioral compounding may matter as much as financial compounding. Now let's bring this masterclass back to its starting point. Dividend investing for beginners begins with a simple question. What if your money could work for you instead of the other way around? Over the course of this framework, you've learned that dividends are not magic. They are distributions of real profits from real businesses. They require capital, patience, analysis, and emotional discipline. But they also create something powerful, an expanding stream of passive income that is not directly tied to your hours worked. Financial independence is rarely achieved through speculation. It is achieved through ownership, consistency, and time. If you commit to investing regularly, prioritizing quality businesses, reinvesting dividends during accumulation, managing risk intelligently, understanding taxes and account structure, and maintaining a long-term perspective, you build more than income. You build financial resilience. You build optionality. You build freedom. Dividend investing is not about chasing yield. It is about constructing a durable income-producing asset base that grows with you over decades. It is about shifting from consumer to owner, from wage dependence to asset ownership, from uncertainty to structured progress. The stock market will fluctuate. Economic cycles will come and go. Interest rates will rise and fall. But well-managed businesses will continue generating profits. And those profits, when shared through sustainable dividends, become the foundation of long-term wealth. If you approach this strategy thoughtfully and patiently, you are not simply building a dividend portfolio. You are building a financial system designed to serve you for the rest of your life. That is the real power of dividend investing. And that is how beginners become financially independent investors.